I'm joined by Valentijn van Nieuwenhuijzen. He's a head of fixed income and economics at ING Investment Management. Valentijn, thank you so much for coming in. It seems like it's such a difficult situation because what we hear from our officials here in Europe is that they would be ready to exit. But when you have the Fed putting 600 billion on the market, I mean, do you have to follow them no matter what?
Well, I mean, that's difficult to say. I think the key thing is what happens to the currency. If we see the euro really rising a lot, at some point it will put off the ECB. But we're not there yet. In our opinion, unless we reach 145, 150, the ECB is not going to change course and therefore will continue to follow a path of gradual normalization towards somewhere next year a first rate hike.
Is this what you're also expecting from the Bank of England today?
Not at all. The Bank of England is a completely different story.
Because of inflation?
Well, not only inflation. I think actually the amount of fiscal tightening that UK will go through next year is from a completely different magnitude. And as a result of that, in combination with the ongoing weakness in the housing market, we're more inclined to feel that the Bank of England, although it will not announce it today, might very well be inclined to also employ some additional QE somewhere next year, probably in February.
Valentijn, what does it mean for your strategies in terms of, you know, buying up bonds?
Well, I mean, the overall backdrop for us is still very constructive for fixed income as a whole. For treasury markets, you know, these QE efforts basically mean that yields are kept on the upside. Meanwhile, we're seeing persistent disinflationary pressures in all out the developed world. The combination of the two for us makes us continues to be constructive on treasury markets. At the same time, the extremely low level of yields drives other investors into a pickup in yield, a search for yield, and that's constructive for corporate bonds, EMD, and all that type of paper.
But there's a danger, of course, that this QE will drive inflation, and that will be bad for bonds.
If that were to happen, yes, but let's fight today's problem and not worry too much over tomorrow's problems, because in the end, the Fed is employing QE, but it's not successful yet in broadening out growth in broad monetary aggregates, let alone have really inflationary pressures in the real economy.
So when do you switch your stance on bonds? When inflation is starting to creep up? I mean, you say let's not worry about tomorrow, but that's an investor's job, really.
It is, but you know, this is really quite questionable. I think it's uncertain. The risks for inflation are, in my sense, maybe even more tilted to the downside still. We've seen what can happen in Japan if the monetary transmission mechanism isn't functioning. It is not functioning yet, so let's focus and see whether we see signs that it's getting back to life. And then I will change my opinion about bonds.
Valentijn, how worried are you about actually European bonds? We're seeing a lot of tightening on the risk, for example, for Greece, but also Portugal. Is this something that's going to come up again? Are we risking default in some of these countries?
Well, I mean, the whole story about some kind of private sector participation in restructuring of these bonds, of course, is now getting into the markets. On top of that, we're seeing in some of these economies that there is a recession going on and actually a weakening of domestic demand. So these are specific issues. We are worried over that. But I think in the end it's clearly so that policymakers will focus on preventing this spiraling out of hand.
Valentijn, thank you so much. Valentijn Nieuwenhuijzen there.